By one measure, investors are more optimistic than they have been in years. Ari Wald with Oppenheimer, Boris Schlossberg with BK Asset Management. Boris, drop it in for us here. Investor sentiment is very high, but the old sort of cover jinx, if you will, does that make you nervous?
It does make me nervous because we're getting very, very frothy on these what we call social indicators. So bull-bear ratio now is 4-to-1. The mention, if you do a Google search of buy to dip, is almost at 2002 highs. As you said, the cover indicator, the cover of The Economist was all about the fact that everything is going up in perpetuity. Those are really, really strong indicators that some kind of a contra-trend rally, contra-trend move is going to happen sooner rather than later. And I'm very cautious at this point, yes.
All right, Wald, I mean, you're known as a chart guy. I'm not sure. Is there a way to chart sentiment and expected market returns, or is there something else that we can look at?
Of course. Sentiment is one of our favorite indicators, Brian. And I think the term Boris used, counter trend, is the important point here. That sentiment levels have become the highest they've been in a number of years. That II bull ratio at 4.0, highest since the history of the poll, going back to 1985, over 30 years, or one of the highest readings, upper 2%. We see this more as a neutralizing signal. We think by itself, these high optimistic readings are not a very good timing indicator. And we think the more important point is the longer term strength in some of the credit and our internal breadth work as well. For instance, if you look back at how the markets traded, we were able to rally through a similar level of optimism in the fourth quarter of 2013. That was the last time the II bull-bear ratio got to that 4.0 level. And it really wasn't until a year later, even almost more than a year later, when credit started to break down, internal breadth started to narrow, and it led to the risk-off disruptions in the equity market. So overall, it's a little bit of a balance beam we're trying to walk here. Tactically, not the time to be loading up on stocks, but our longer term work is still favorable. So we are putting more emphasis on our longer term work. We don't think this is a market top. We think long positions are still warranted. Maybe you want to be a little bit more selective. And I think if you do get a pullback, you'll want to buy it, Brian.
I want to go back to you very quickly, Boris, though, because I hear what you're saying. I understand you can make arguments that valuations are, quote, frothy, to your term. However, if bonds, I don't want to say implode, but start to deteriorate, would that change your mind at all? Because equities would simply become maybe a better asset class?
Well, you know, decline in yields and bonds has been a huge support for equities, and you're absolutely right. But I think what Ari is saying, I kind of agree with. This basically creates the environment for a correction. We need a catalyst. So at this point, there is no catalyst right now that is clear and evident that will create a correction, which is why prices could continue to slowly rise for quite a long time. But we're getting at a territory that is very much flashing yellow at this point, and I think it very much warrants attention for investors to be cautious.
Well, not flashing ready yet, and if it does, Boris, you come on and let us know. Boris Schlossberg and Ari Wald, really interesting, the ratio there, 4-to-1. All right, guys, thank you very much, appreciate that. And thank you for watching Trading Nation. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.